Hi everyone, this is Professor Gallagher. In this chapter, we're going to be talking about payroll taxes. This should be a review for you if you've taken either basic or financial accounting previously. So taxes for federal income taxes are withheld from taxpayers through their regular paychecks, and then they are summarized at the end of the year on an employee's earnings and taxes statement, also known as a W-2. When the taxpayer files their income tax at the end of the year using Form 1040, that's going to compare the tax liability that they owe with the tax payments that they've made through withholdings throughout the year to determine if that individual taxpayer will receive a refund or if they'll owe more money. The withholding taxes are an approximation of the share of total tax liability that the employee is going to owe. The Form W-2 is completed by the employee to determine their withholding allowances for the tax year. This is normally completed when you take a new job. There's two methods that a employer will use to calculate the withholding amount. This is the percentage amount. This uses the range of percentages to calculate the taxes. And this is used mostly in computerized payroll systems. And there's also the wage bracket method, which uses the table to calculate the taxes that are withheld based on the salary brackets and the number of allowances. In addition to federal tax withholding, there's also FICA tax withholding, which this is your Social Security and your Medicare tax. The Social Security tax is 6.2%. up to a maximum of $128,400 for 2018, and Medicare tax is 1.45% on all wages. There is no maximum for that. There is a matching tax for FICA, so the employers also pay a matching portion of this tax. In addition to that, there is a 0.9% tax for Medicare, which is withheld for employees that earn more than $200,000. And there is no employer match on this portion. This is part of the Affordable Care Act. So let's take a look at a quick example. We have Jenny, who earns $130,500 in 2018. How much Social Security tax will be withheld from her compensation? Well, her $130,500 is over the Social Security cap of $128,400. So her Social Security tax is going to be based on the limit of $128,400 times 6.2%. That gives us $7,960.80 that will be withheld throughout the year for Social Security. And for Medicare, Medicare is going to be based on her total earnings of $130,500 times 1.45%, which will give us $1,892.25 that will be withheld throughout the year. Employees are required to report any cash tips that they receive to their employer by the 10th of the month after the month in which the employer received those tips using Form 4070. And then the employers must withhold income tax and FICA based on those tips that are reported. Large food and beverage establishments may be required to allocate tips to employees if the employees do not report tips in the amount of at least 8% of gross receipts of that establishment. The employer would use Form 8027 to allocate the difference to the employees, and the employers are not required to withhold taxes on any allocated tips. These allocated tips will be reported on Form W-2 to the employees at the end of the year. So let's take a look at an example. In a large food or beverage establishment, any tip shortfall from a directly tipped employee is recorded on the employee's W-2 and the correct answer would be W-2, box 8, which is allocated tips. So once the employees have withheld the withholdings from their employees' paychecks, the employers must make payroll tax deposits of the amounts that were withheld. So there is a look-back period that determines whether an employer is a weekly, semi-week, or semi-weekly scheduled depositor. So through the IRS will look back at the last 4 quarters that start in with July 1st, 2016 through June 30th, 2017 for wages paid in 2018. If there is $50,000 or less in tax liability during that look-back period, the employer would need to make payroll tax deposits monthly. If there was more than $50,000 in tax liability, that employer would need to make payroll tax deposits semi-weekly. The semi-weekly deposit schedule is shown here. All employees now must use the electronic funds transfer payment system in order to make their deposits. If there is an employer who accumulates $100,000 or more in taxes on any day during a deposit period, that employer must deposit the tax by the next banking day, regardless of the type of depositor that it normally is. That employer would then become a semi-weekly scheduled depositor for the remaining of the calendar year and for the following year. So, employers are required to file Form 941, which is a reconciliation of the amount of payroll tax liability and the payments that were made by the employee to cover the liability. And this is due by the end of the month following the close of the quarter. If there is a tax liability of less than $2,500 at the end of the quarter, then this amount can be paid when the Form 941 is filed. There is also a Form 944, and that's for very small employers. If an individual is self-employed, self-employment taxes are going to be assessed on earnings of $400 or more that are generated by a sole proprietor. We talked about that in Chapter 6. They are also required to file the self-employment schedule on their 1040, which determines their self-employment taxes that are owed. So the self-employed taxpayer is responsible for all parts of FICA, the employer and the employee side. The federal unemployment tax, FUTA tax, is 6% on wages up to $7,000. There's a maximum credit for any state employment taxes. There's SUTA tax of 5.4%, which can reduce the amount that is owed to the IRS to 0.6%. Form 940 is filed annually by the employer to report and reconcile any Federal Unemployment Tax Act liabilities and payments. So the next tax thing that can come up with payroll taxes are household workers. Household workers are considered employees and are subject to federal income, FICA, and FUTA taxes. If they are paid wages of $2,100 or more in 2018, there were federal withholding taxes withheld from these workers, and they had wages of at least $1,000 paid to any combination of the household workers in any calendar quarter in 2017 or 2018. So a household worker could be like a nanny if you have someone come take care of your children within your home and they're not employed by any other type of service that you're paying hourly for that service. Or if you have a house cleaner or who knows, a chef or a pool person that you employ directly and is not considered self-employed or employed by another company. The Schedule H is completed by the employer and is going to be submitted with the employer's 1040. So the Schedule H is going to be completed by the person that is employing the household worker, and that will reconcile any federal income tax, any FICA, and any FUTA taxes that are owed for that household employee. So let's take a look at an example. On January 2nd, 2018, Jane employed a part-time household worker in her home. She paid the household worker $350 per month for 2018. What is the amount of FICA tax that Jane is required to record on Schedule H? So the worker was employed for all 12 months of the year, so they are paid a total of $4,200 for the year. So we need to first calculate Medicare or Social Security tax, 6.2%. So that's $260.40. And then we have Medicare tax of 1.45% on the $4,200 that was earned. So that's $60.90 for a total amount of FICA taxes of $321.30. So as we talked about in I believe it was the first slide, employers are required to report earnings to their employees and the amount of taxes that were withheld on Form W-2. These are due to the employees by January 31st of the next year. And then copy A is also sent to the Social Security Administration. And then Form W-3, which is a transmittal form that summarizes all of the employees' W-2s, is prepared by the company, and it is sent with a copy of all of the employees' W-2s. If there is a W-2 that was incorrectly prepared, then a Form W-2C, a statement of corrected income and tax amounts, would be prepared to fix that W-2. In addition to that, there would need to be a W-3C, a transmittal of corrected income and tax statements that is sent to the Social Security Administration. If an employee has supplemental wages, which this is wages that are paid in addition to an employee's regular earnings, so this could be a bonus, something of that nature. Withholdings on supplemental wages can be calculated using one of the two methods. That it can be taxed at a flat tax rate of 22%, or the employee could combine the supplemental payments with the regular rate wages and then calculate the tax withholding that way. If an employee does not furnish their taxpayer identification number or Social Security number when they prepare their W-9, the employee or their vendor must withhold 24% of taxable payments. These payments could include interest, dividends, rents, royalties, commissions, non-employee compensation, and any other types of payments that are made in a regular course of trade or business. So to not have to withhold that 24% backup withholding, the employee or any vendor that you're working with needs to prepare a W-9. This will state their name, business, address, their Social Security number, all of their information that is needed to correctly either give them a W-2 at the end of the year or 1099 if they're self-employed. If the taxpayer fails to furnish their correct taxpayer identification number or Social Security number, this can result in a $50 penalty. And there is also a penalty for willful neglect in completing the form, which is $500. So this form is used to certify that that taxpayer identification number that the taxpayer is using is correct, and to certify whether that taxpayer is subject to backup withholding or not. And the last thing that we're going to talk about is estimated tax payments and the Form 1040-ES. The Form 1040-ES is used when a taxpayer must make estimated tax payments for estimated taxes due. So estimated taxes usually come into play if an individual is self-employed. They will need to, since they don't have an employer that is withholding their taxes for them from their paychecks throughout the year, they will need to send in estimated tax payments quarterly to the IRS to start paying their taxes that are due for that year. Estimated tax payments are going to be required if the unpaid tax liability is more than $1,000 and withholding and credits do not meet certain safe harbor thresholds. So we talked about this in another chapter. The safe harbor thresholds are either 100% of the current year's tax liability or 90% of